Hello and welcome to Market Call. I'm Mark Bunting. For the next hour, we have David Burrows, President and Chief Investment Strategist at Barometer Capital Management. He'll be taking your calls, emails, and tweets on North American large caps. Here are the ways to reach us. So you can call us toll free. The number is 1-855-326-6266. The email address, marketcall@bnn.ca, or tweet us at marketcall. David, always good to see you.
Great to be here, Mark.
We were just talking off air, and you think that this is a much different market than we've seen in the last, say, 12 years, and it's more like the 90s. How is it different?
Well, you know, if you think about it, all through the 90s, you had falling inflation, you had a relatively strong consumer, you had earnings multiples expand in 8 out of 10 years as equities got revalued through that period. And all through that period, if you were a targeted investor, there were some very clear themes that emerged that you could take advantage of, and the themes had some longevity. If you look at the period from 2000 through 2012, early 2012, we had a market that was dominated by cyclicals, emerging markets, commodities. You had a market where the earnings multiple for the market actually contracted all the way through that period, and you had a lot of short-term rallies and short-term declines, but the market made no progress. As of about 16 or 18 months ago, correlations started to fall again. The earnings multiple for the market started to expand. Inflation started to fall. And some very clear themes started to emerge, which are very different sectors than have led the market over the last number of years. So things like consumer, technology, healthcare, which had been out of favor, for 12, 13 years, really have been leading. Correlations are falling, so stock picking becomes a lot more important. It's a lot less risk on, risk off. There's more persistence to the themes. And the corrections are shallower because there's such under ownership of equities. So at Barometer, we really believe we are in a new secular bull market for stocks. And the biggest risk I think that investors have probably is being too pessimistic and under-owning equities as a percent of their total investment portfolio.
So essentially what you're saying is that history may not repeat itself, but it may be rhyming the 90s?
Right, well everybody's expecting after a good year last year that this should be a correcting year because that's what we've seen over the last number of years. And in fact, in the 90s, there's only 3 times in 50 years you got a 2 earnings multiple point expansion in the market. In each of those 3 periods in the last 50 years when that happened, the following year was a solid positive, and in 2 of the 3 years, the third year was a solid positive. So the risk is that people say, well, I'm going to wait for it to have a big pullback, and the pullback doesn't come. So investors slowly moving from fixed income through dividend growth, which continues to do very, very well, but then probably a little further out the risk curve to growth-oriented securities, and that's really where the money's being made, as we see every day in the market.
Do you encounter people, clients who maybe need to think differently, change their behavior because they're still worried about '08 and downturns in the market?
I think there's no question. People keep making comparisons to that market. We're in a very different world. Leverage in the market is way down in the financial services companies and so on. But one very large U.S. institution we talked to they told us just under $1.8 trillion of private client money under administration. Average client was 62 years old. Average client had 12% of their portfolio in cash, 20% if you included short-term deposits, and just over 50% in fixed income. So that's roughly 70% of the average portfolio for very wealthy Americans sitting in cash and fixed income. So in a very low-rate world, money slowly rotates back towards things that will give them a better return. Dividend growth is the obvious camp, and that's been seeing money rotate for some time. But equities are really under-owned, and so these pullbacks will be met by buyers. And we're seeing each of the most recent pullbacks much shallower, I think, than people expect.
And the rebound was pretty sharp just a few weeks ago. And just lastly here, this all sounds very blue sky, but are there any red flags, risks? What about investors using a lot of margin? Aren't there some scary charts out there?
Well, interestingly enough, one of the prime brokers that we spoke to in the U.S. told us last week that short interest in their hedge fund clients was 40% higher than at the highest point in 2008. So there's a lot of people trying to fade this market. Now, long-only investors are seeing net inflows come in, and that's steadily working its way into the market. But the hedge community still is very reticent. in this area. So I think the biggest risk is emerging markets right now. We're seeing some currency weakness in South America and through Asia. And there is some credit risk there, I suppose. But I think that it's far better than what we saw as a potential in 1998. So we're focused on developed markets, specifically the U.S., because balance sheets are in great shape and earnings are growing nicely.
Okay, David, fascinating overview there. And David, we'll start drilling down on your questions about North American large caps after this.